Hi, this is Tanya from dmca Advisory. I just want to spend a few minutes explaining the Commonwealth Bank off-market share buyback that's been announced, just to show you what the benefits are, particularly for low or zero rate taxpayers, and to hopefully help you make a decision as to whether it's something you'd like to participate in. So the way it works is that CBA are looking to buy back up to $6 billion worth of shares. And really the main reason is so that they can distribute some of their excess franking credits back to shareholders. So what would happen is that it's not compulsory, but basically ask shareholders to tender their shares at a discount, anywhere from 10% up to 14% discount. But as we've seen in the past with these type of buybacks, it's only really those shares that are tendered at the maximum discount of 14% that end up being bought back. And that's because there's so much demand from shareholders to participate. So in my example here, I've got this shareholder owning 1,000 shares. I've assumed they paid $80 per share for working out capital gains tax. And then we're going to tender the shares in the buyback at the maximum discount of 14%, which means we'd receive $87.72 per share. Now, of that amount that we receive per share, it's already been set that the capital component is $21.66, which means the rest is a fully franked dividend, which is where we get the tax benefits from. So at the table down the bottom, I've shown all of the different types of taxpayers and different tax rates. I really just want to focus on the first three. That's a super fund and pension phase, 0% tax rate. We've got a super fund and accumulation phase, which has tax on income at 15%. And then we've got our Australian resident earning less than $18,000 and they're on a 0% tax rate, because they're really the three types of shareholders that would benefit the most. So the first thing we've got there is our fully franked dividend component. So as I said, $66 per share, 1,000 shares. In each case, the taxpayer would receive a dividend of $66,000. We'd have our franking credits attached of $28,311. So as we know with dividends, we need to gross that up to work out what our total taxable income is in relation to the dividend. Then if we come down and look at the tax on that dividend, we can see the super fund and pension phase pays zero tax, as does the resident individual earning less than $18,000. In the middle there, we've got our super fund 15% tax rate. So that has a little bit of tax to pay as well, $14,000, just over. In each case, when we deduct the franking credits, the super fund and pension phase and the individual, we're going to get that full franking credit back as a tax refund. The super fund paying 15% tax, we'll still get a $14,000 tax refund. So still a very reasonable amount, which is where the tax benefit comes from. So then if we have a look at what our after-tax proceeds are in total, so of course we've got our full $87.72 per share that we've received. So that's just under $88,000 in total. Then we've added on our tax refund that we've received in each of those three cases. So for the super fund and then individual, our after-tax proceeds are $116,000, whereas for the super fund at the 15% tax rate, we're just under $102,000 total after-tax proceeds. So now let's compare that to a situation where we've got selling the shares on market. So again, we've assumed our market price of $102 per share. So in each case, we receive $102,000, less a little bit of brokerage, take off our cost base of $80,000, look at what our capital gain is, which is $22,000, a net capital gain, which is after the 33 1/3% discount for super funds or 50% discount for individuals. And look at what tax we'd have to pay. So of course the super fund and pension phase and the individual on 0% tax, our net proceeds after tax is $102,000. Super fund in the middle at 15% tax rate would have a little bit of tax to pay, just over $2,000. So we're going to have just under $100,000 after tax proceeds. So now let's compare the two. So if we've got our off-market buyback of the shares, the super fund on 0% and the individual on 0% tax, we've got after-tax proceeds of $116,000 versus the super fund in the middle on 15% tax, after-tax or off-market benefit of $106,000 total proceeds. Compare that to the on-market sale proceeds. You can see there that the super fund on 0% tax and the individual on 0% tax, we're actually in front by $14,000 or $14.03 per share by participating in the share buyback. Even on the super fund side that's paying 15% tax, there's still nearly $6,500 benefit there. So $6.49 per share. So hopefully you can apply those examples to your situation to determine whether you think it's worthwhile participating. If so, please do get in touch and we'd be more than happy to help you complete the paperwork to participate in the buyback. Thank you for listening.